Work on a project. Like now. I'm not. I was like, I was so sleepy. I guess very related. Yeah. Yeah. I'm here. I'm down to help you out. Go to the group chat and expect because
It was so much fun. Yeah. You got a couple friends and everything, right?
Yeah.
Oh, that's okay. Applications. You get all caught on, like, better.
Yeah, I like
Yeah.
What
Hey, folks, welcome back. Sorry about the screw ups in the case, and I hope you've got the updated version on those items. Growing, you have no idea what I'm talking about, and if you haven't even downloaded the case, you're safe, right? So you get the updated version. Can you hear me? Okay. Before we start, couple of questions. I mean, at the start of this class, I said there were first principles in finance that you violate at your own risk, right? Lots can happen in 9 days, as you've discovered since last Wednesday, or a week ago Wednesday. The world seems to have upended. And of course, the big story was Silicon Valley Bank. What was the first principle that Silicon Valley Bank violated? What did they do that basically is at the root of the problem? Anybody want to try? They did a duration mismatch, right? They took deposits in, which were either demand deposits, which basically means you can get your money out at any time, or even if they were interest-bearing deposits, 3-month or 6-month deposits, and they invested it in 10-year bonds in 2020 and 2021. There's usually a good reason people give for violating first principles. So what is the reason they would have given for doing what they did in 2020 and 2021? I mean, this sounds like a stupid thing to do, right? Why take demand deposit? No. And they're not alone. Banks across the country did it. We'll talk about why Silicon Valley Bank is in a class of its own. But why did they do it? What was the motivation? They were capturing the spread, right? Basically, at that time, even if they had interest-bearing deposit, they were short-term, they were paying 0.05%. They were making 1.7% on bonds. They said, this is easy money. We're going to capture it. And of course, in 2022, the world upended on them. Long-term rates rose and short-term rates rose even more. And now they had all these bonds that they'd bought at 1.7% rates that were now, remember we computed the market value of debt and you wondered, why do we do it? If you did this with the book value of Silicon Valley's debt, they had $91 billion in treasury bonds on their books at a 1.7% rate. If you took those bonds and you revalued them at a 4% rate, you know what the value of those bonds would be? About $72 billion, $19 billion less. You wouldn't have seen it on the balance sheet. And here's the other thing we talked about, how accounting is internally inconsistent. Because they were classified as hold to maturity, which means the bank certifies they're going to just hold them to maturity. Clearly, they're not held to that certification. the accountant said you can leave it at face value. But so when people say, I didn't see this coming, see it coming, right? There was a $19 billion write-down you were going to take. And that would effectively have left. And this is not even looking at the venture debt, which is a strange creature that I will talk about. I've never understood that entire business. Because usually when you lend money, what do you lend it against? That a company has earnings or cash flows. Venture debt is debt to startups. So what is being used to pay it off? What's the backing that is behind venture debt? What do banks hope will happen? That new venture capital money, it's basically lending against the next VC round. Is it dangerous? God, is it dangerous? As long as things are going well and you get up round after up round and new capital gets raised.
That's right. I think your microphone is off.
Yeah, ask you to turn it up a little bit.
I think it's on, but I think it's just low.
Turn it up just a little bit. Artillery years back there.
So venture debt, as long as things are going well, you're going to be fine. So you've got, so the force I think that you'd think would bring them down to the venture debt wasn't what brought them down, it was the T-bonds. As I said, they were not alone in doing this. This is something that banks across the country did. Why? Because they fell into that swoon of the Fed, whatever it wanted, keep rates at wherever they want to be forever. I mean, collectively, I think there's about $600 to $700 billion of write-downs that banks have to take. So why isn't every bank going to be like Silicon Valley Bank? Silicon Valley Bank was unique in the sense that 60% of its assets were in treasuries and mortgage-backed securities. A typical bank that's like 15 or 20%, the rest is in loans, 60%. Why was it so high? Not like an absurd, you're not a hedge fund, right? You're not taking money in deposit and investing in, you shouldn't be doing this. So why was it so high? Because in 2021, they doubled their deposit base. They went from $100 billion deposit base to $180 billion deposit, or a $90 billion to $180 billion. And why do you think that happened? Because this is a bank that was designed for Silicon Valley, right? It's a bank for VCs and founders and startups, their employees. And 2021, the VC business slowed down. There weren't as many investments, and VCs had what's called dry powder, a lot of cash. And they put that cash into Silicon Valley, essentially doubling the deposit. You can see how the effects build up, right? So they had this huge inflow of deposit exactly the same time that startups were slowing down. So they didn't have any venture debt to do. So the money went into bonds. So in a sense, this was like the perfect storm. And here's the final piece of the storm. What allowed them to grow so fast? They had a viral clientele. You know what I mean by viral clientele? Everybody in Silicon Valley is connected to everybody else. This is their business, right? Everybody's on their phone. They're really not making any real product. They're just talking to each other. And that helped them on the way up. And here came the trigger. And this is actually ironic. Silicon Valley Bank clearly knew they were in trouble, so they wanted to get help here. So what did they decide to do a couple of weeks ago to make themselves healthier? If you're a bank and you feel you're undercapitalized, you have to raise equity. And they decided to actually take some of those hold to maturity bonds, sell them, take the loss, and issue fresh equity. This is good, right? But they mangled that. Goldman Sachs has to share some of the bank. They mangled that so badly that the news that they were going to do this came out before they had the equity lined up. And then all heck broke loose. You can see phones lighting up all across Silicon Valley, right? People say, get the money out of the bank. In the space of 24 hours, essentially, you got a bank run. And now, of course, we're left with the shambles. The problem, though, is when you have a big bank go down, it's the 16th largest bank. This is not a small bank. Now the subsequent storms don't have to be as big. So when you look at Signature Bank and First Republic, their problems are much smaller than Silicon Valley. But once, I mean, remember, banking is built on trust, right? If we all went into JP Morgan Chase and demanded our deposits back, JP Morgan Chase would be in trouble. This is, if you think about the world we're in, you think about, I mean, I've described Bitcoin as a currency built by the paranoid for the paranoid, built on no trust at all. That's one extreme. And you have the old banking system built on complete trust. We're in a strange place now because starting in 2008, we don't have the trust we did in the banking system. So everything is now, there's a tipping point for everything. So this week is going to be critical because First Republic is, of course, next in line. And my guess is it has to be acquired because once the trust goes, there's nothing management in a bank can do to fix it. They tried last week, as you know, some of the biggest banks got together and they said, we're depositing 30 billion. Sound like, like monopoly money to me because I don't know what it means to actually redeposit from your bank to another bank. For a day it worked, but then the next day people said, what the heck does that even mean? And we're back digging a hole again. So I wouldn't be surprised by Wednesday or Thursday, First Republic is acquired. Acquired is really the wrong word because Credit Suisse got acquired by UBS, right? But at how much is UBS paying? 3 billion? Take a look at the market cap of Credit Suisse a month ago. This is not an acquisition. This is just, take this and run it, and it's with a gun to your head. UBS doesn't want the crap that comes with Credit Suisse, but this is not a choice. So I think that you're going to see a big bank be, in a sense, it's going to be a forced marriage of acquired. So it's, may you live in interesting times, and we do, right? So that's the thing about corporate finance. Something always happens. Hopefully this will not make all your companies kind of go into a spiral. And that's why I asked you not to pick a bank. Hopefully you kept, listen to that advice. In the corporate finance project, the valuation class, people have picked banks. Hopefully none of them have picked Silicon Valley Bank because now you got to pick a different bank. Because how do you say buy, sell, or don't hold to something that's already gone? So something to think about. Let's go back to where I left you for the break. We were talking about measuring returns, and I talked trust cash flows rather than earnings. I told you the Winston Groom story. I'll tell you one more story to kind of illustrate how much you should not trust earnings. So this is a personal story. I'm just finishing up my 11th book. I have 4 different publishers. I hate them all. I think publishing as a business is kind of stuck in the 20th century. They can't figure out what to do. But I write because it allows the book to kind of get to parts of the world that I cannot get into. So one of the things, of course, do any of you own any of my books? It's not required for the class. Which book do you own? The gray one. It's clearly made an impression on your color at least. Applied corporate. Do you remember how much you paid for that book? That's cheap. I remember when I wrote that book and I asked for 10 copies, and they give a 50% discount to the author. And I get the copies and I get a bill for $650. And I said, what the heck is this? They said, that's the half price on 10 paperbacks. They said, we priced it $130. I sent it back. I said, I'm not paying $650 for 10 paperbacks. You can keep them. It's an obscenely overpriced book. I wouldn't buy it. That's why I don't require you to not. You think I'm getting rich off the books I'm selling you, right? So every 6 months I get a royalty statement from my publisher, in this case, John Wilder. And it's one of the most depressing moments of the year for me. You get the royalty statement. It'll tell you how many books you sold. And my original contract actually looks pretty good. It entitles me to 15% of the net proceeds of the book. Watch for the word net. There's many a slip between the gross and the net, and I've learned this the hard way. But you think 15% of $130. So when you buy a book for $40, I should be collecting $6 for myself, right? So every 6 months when I get a royalty statement, I take the total royalties that I get paid. I divide by the number of books to see how close to $8, $10, or $15 that I get. I've never made more than $1.50 ever. So what happens? There's many a slip between the gross and the net. They'll tell me how many books I sold, and then they'll tell me the price of the books, and they start listing line items. And most of them, I have absolutely no idea what's happening, other than the fact that it's making the number smaller. I'll give you my least favorite line item. 50% of my royalties disappear every year in what's called a year-end adjustment. What the heck is a year-end adjustment? December crept up on you unexpectedly? Let me give you a clue. It's October, December is coming in a couple of months. And what exactly do you do on December 31st? Take half my books and throw them into the Hudson? So first time I got it, I went and looked at my royalties, the agreement. It's written by lawyers for lawyers. I have absolutely no idea. There's a clause on it for a year-end adjustment. It goes a page and a half. It talks about a year-end and an adjustment. The rest of it is absolutely mysterious to us. I called Wiley, the legal department. Of course, I talked to a lawyer. Might as well talk to a wall sometimes. So I say, what is this? And, they go on and on and on about this year-end adjustment. Finally, I hang up the phone. There's nothing I'm productive with this. And I plotted my own petty revenge. And you might be beneficiaries of this. So here's what I do. I write the way I write a book. I write a chapter at a time, and each chapter I create a PDF version. I put it online, ostensibly to get corrections done by people reading it online. So chapter 1, chapter 2, chapter 3. I think the investment valuation book has 36 chapters. I get to chapter 36. I put chapter 36 on. The 1 through 35 already there. The book goes to the publisher, it goes to the printer, gets printed, it goes into the bookstores. I forget to take the PDF files out. I remember the first time this happened, I get this frantic call from my publisher saying, "What the hell are you doing?" And I said, "What are you talking about?" So your entire book is online. I said, so you lose royalties. And they said, I make $1.50 a book. I don't care. Maybe if I made $15 a book, I would care. Why don't you call me back when that's true? They haven't called back since. All of my books are online. The only thing is I can't be too open about this. I give them other names. Mexican, for a while I used Mexican menu items. This is burrito, you click it, investment valuation book downloads, 1,500 pages. Right? Taco, there's your applied corporate finance book. So click around my website, somewhere in there, the entire book is available. And don't feel bad about taking away my royalties. $1.50, I frankly don't care. Earnings versus cash flows. Second basic principle, use incremental cash flows. Today, we'll talk about examples of what's incremental. Basically, a cash flow should affect your analysis only if it's the result of a project. Taking something that's already there and moving it to a project is not incremental. It's going to be there anyway. I'll give you a very simple test to determine whether something is incremental. So you want cash flows, you want those cash flows to be incremental. And finally, you want to time weight those cash flows. Fancy word for discounting, right? That's what time weighting is. In the old days in corporate finance books, we no longer do this. The last part of the book used to have time value tables. $1 in 1 year is worth 90.91 cents. So basically, you could look at a discount rate and see what $1 is worth in 1 year. And what you would see is the further out in time you got a cash flow, the less it was worth it. A good measure of return will be a time-weighted incremental cash flow return. I want you to hold on to that thought because I'm going to take projects and I'm going to compute different ways in which people come up with returns. And I want you to pass them against the test. Is it based on cash flows? Is it incremental? Is it time weighted? So let's start with what a project is. My definition of a project is everything you do is really a project. From the smallest change in working capital or inventory policy to an acquisition, we're talking about projects. You can have revenue generating projects, you can have cost cutting projects. So when you replace one IT system with another, you might not get any revenues as a consequence, but you might be able to reduce your costs. So we're going to look at a bunch of examples, and I'm going to go through the examples we're going to do in class, and I hopefully can get the spectrum. First, at Disney, I'm going to look at a traditional infrastructure investment, a new theme park that Disney is planning to open. And this is in my mind. So this is not some advanced notice I'm giving you of what Disney's plans are. We'll call it Rio Disney. So they're going to create theme parks, essentially a Magic Kingdom and a second theme park. And we'll go through the process of should Disney make this investment. So I'll do the hard work of grinding out the numbers. You're going to have to sit back and your only job is to decide based on the numbers you get, whether this investment is a good investment for Disney or whether they should not take it. A second example I've added for this year is a project for Disney Stream. And as we go through that example, you're going to see how difficult it is to actually make a judgment on whether to create something for a streaming project, because the revenues are implicit, right? You don't charge people, but you hope to add on more subscribers. So let's take the Daredevil show that they're planning for next year. One of my favorite shows on Netflix. It's now coming back, 18 episodes. You know how much it cost Disney to make, one of those the Avengers or the episodes they're making now for the Mandalorian? 30 million an episode. So let's make this 20 million. 20 million times 18 is $360 million. This is a big investment. We'll talk about how would you evaluate an investment like that where the revenues are not directly observable. Then I want to talk about a new iron ore mine for Vale, which is going to be set in Canada. Remember, Vale is a global iron ore mining company. It doesn't get all of its iron ore in Brazil. In fact, it's all over the world. It's going to be a Canadian iron ore mine. We'll talk about how to evaluate that project. Then we'll move on to Bookscape creating an online store. Remember, it's an independent bookstore. People are no longer physically coming in. They want digital versions. The online bookstore is going to offer both digital versions and ship out books if that's what you want. And finally, I'm going to talk about Tata Motors acquiring Harman Audio. Harman's this, well known. They make speakers. They made they go back in time. But Tata Motors wants to acquire them for synergy. You see, what's the synergy of an automobile company acquiring? Let's face it, you spend your time 2 hours a day in a car. You want the best possible audio system. So some of this is going to be based on synergy. Some of this hoping to get a presence in the US. Each of these we're going to examine, but I'm going to spend the bulk of my time with a Disney theme park. I'm fresh off 4 days at Disney World. Okay. It's a long planned trip with my 3 sons and my grandson. We planned it for March of 2020, spring training for the first 2 days, watching the Yankees in Tampa. And then, so of course, March of 2020, our plans crashed and burned because of COVID. So we've been putting it off and putting it off. So finally we did it. So Disney's fresh in my mind, and I probably remember things about Disney. I also go to Disneyland about 30 times a year because my son works at Disney, so I can get it for free. This is a great way to spend time with the grandkids. So this is going to be a set of 2 theme parks that Disney is planning in Rio. The first one is going to be a Magic Kingdom. First, before I go any further, how many of you have never been to a Disney? We need to make one of those Super Bowl ads. Once a class is over, you know how after the Super Bowl, Eli Manning, as a Giants fan, I'll go back in time. You won the Super Bowl, what are you going to do? I'm going to go to Disneyland. But even if you've never been to Disney, you've seen what Magic Kingdom looks like, right? There's always a castle in the foreground. A different castle in each theme park, but there's a castle. It's a fake castle, but that goes without saying. It's Disney. Everything is fake. You walk through the castle, and where are you? In the happiest place on earth. That is not my description. That's Disney's description. You're surrounded by families dragging screaming kids around, but the happiest place on earth. And you walk in and you got a Dumbo ride right in front of you, and surrounding you are all the kids' rides. And then you keep walking, and of course, you have other stuff. So the first park is going to be a Magic Kingdom because you can't have a Disney park without a Magic Kingdom. The second is going to be a variant on Epcot. You guys been to Epcot? Scariest experiences of your life. Okay. You get past the big ball that symbolizes you have this lake surrounded by the world. So for those people who are too lazy to travel and want to see the world, you walk around the lake. You see Mexico, you see Norway, you see Germany. You basically eat your way around the world in about 3 hours. You feel terribly full, but you've seen the world. There's some countries that they miss. When I walked into the Norway pavilion, was how many people live in Norway? 10 million. And I keep walking and walking and walking around the lake. You know what country you're not going to see? You miss India. That's like 1 billion people. I would suggest taking over the Norway pavilion and making it the India pavilion, but that's a different, different graph. So the second theme park is going to be an Epcot. And here's what it's going to do. First, the Magic Kingdom is going to be constructed in year one. It's going to be quicker to do because they've done it elsewhere and be open for business at the start of year two. Sometimes we forget with infrastructure projects that things don't happen instantaneously. It takes a while. Epcot is going to take a little longer. It's going to take the second and the third year, be open for operations in year four. And initially, I told you I'll do the number crunching. I'm going to cheat and give you all the numbers in US dollars. Why is that cheating? Because these theme parks are set in Rio, the cash flows are going to be in reais. And for the moment, given that decision makers in Disney are more comfortable with dollars, I'm going to say, at the end of this process, I'm going to switch and ask, would my analysis have been different if I had done everything in Brazilian reals? So it's going to be in US dollars. So let's set the table. I'm going to start by laying out the facts on what this theme park is going to cost to build. So the Magic Kingdom, so first, before I get started, Disney has already spent $500 million doing the legwork for this project. What does it involve? Licenses, whatever you need to spend. And this is critical. They're not going to get that money back if they choose not to build this theme. That's going to be critical in this analysis. Spend $500 million. And also they've capitalized. Let me pause for a moment. When you spend money, you can either capitalize it or expense it. What's the difference? When I capitalize it, what do? You put it on your balance sheet as an asset and you depreciate it over time. When you expense it, you take the entire amount, shorten your income statement as an expense. In this case, they've capitalized and they're going to depreciate it over the next 10 years. Let's keep depreciation simple, straight line depreciation. So they have $500 million they've already spent, they're not going to get it back. But they have more money they need to spend. The Magic Kingdom is going to cost $3 billion to build. It's going to take $2 billion that will be spent right now and $1 billion a year from now. Now, in reality, people don't spend money at points in time, right? So we're simplifying the world. In the real world, you spend money every day. By having this discrete time and making life a little simpler for myself, it doesn't make a huge amount of difference in my analysis. So $2 billion right now, $1 billion a year from now. Epcot is going to cost another $2 billion, $1.5 billion, $1 billion at the end of year two, and $500 million at the end of year three. So here's what you have is your spending. So the $2 billion is right now, $1 billion a year from now, and the remaining $1.5 billion in years 3 and 4. So that's going to be the total amount. In sum, Disney will be spending $5 billion in the theme park, but $500 million has already been spent. Now, I'm also going to try to make revenue estimates for these theme parks. But I want to pause right here. Let's say you're the low man on the totem pole or the low woman on the totem pole at Disney. You know what your job is, right? To do the grunt work. So your CFO comes to you and says, look, we're planning this theme park in Rio. I want you to fill in a spreadsheet with projections of revenues in the theme park. Remember, you're looking at a blank spreadsheet. How would you go about populating the spreadsheet? It makes it specific. The Disney theme park in Rio, what are some of the things you're going to look at to make your estimates of what the revenues are? Sir? And first, you'd also look at how many customers come in, right? You have 4 or 5 theme parks around the world. And you might say, look, based on the population, this is how many people come in. Then you estimate the ticket prices, the additional spending. But the problem is often in corporate finance classes, we act like these cash flows are just given to us. The reality is they're estimates. They're estimates based on what you've already done in this case. And you can already see why entering a new business is more difficult than entering a business you've already been in. Because if it's a new product, something you've never done, Disney Plus must have been a nightmare to forecast. They'd never done something like that. But in this case, I was a theme park, so I'm gonna make the estimates. Remember, I'm the low person in the totem pole, I'm gonna grind out the numbers. So here are my projections. There are no revenues in year one. Why? Still building. Maybe I wasn't creative enough. I'm sure people will pay to watch a Disney theme park being built. Now, I should have thought about that. Pay you for $50, you can come and observe the next Peter Pan ride being built. But no, in this case, let's make revenue zero in year one. In year two, you see the revenue start in Magic Kingdom. It starts at $1 billion and it builds up. Why? Because it takes a while for a theme park to find its legs. You're still testing things out. The rides are not all fully functional. And you can see that the growth kind of continues, but the bulk of the growth happens early. So you can see the revenues build up. On Epcot, you have no revenues for the first 3 years construction. Year 4, the revenues kick in and they build up over time as well. The collective revenues at the two theme parks include not just tickets, but also the other stuff you spend on it. You're saying, what's the third column? Resort properties. You go to Disney World. If you stay outside Disney World, it'll take you like an hour to get in because Disney owns what? Tens of miles around the theme park. So Disney's built resort properties, right? The Swan, the Contemporary. The only reason for staying with those properties is because you go to a Disney theme park. In other words, they leech properties. They live off the theme parks. So the resort properties here are basically the revenues I get at those hotels. You're saying, how do you come up with those numbers? I looked at Disney World and looked at how much the property revenues were as a percentage of the theme park. Now, of course, the pushback is this is Rio. Maybe people will not stay as much, but the starting point has to be what you already have, and then you adapt those numbers. In fact, I've set the revenues at the resort properties to be 25% of the revenues. You could argue it should be higher or lower, but the collective revenues include all of the revenues I will get from these Disney. Any questions on forecasting revenues? I want you to visualize whatever company you're doing and think about what a typical project looks like for them and say, how would I do that? And you can see for companies like the Home Depot, it's relatively simple, right? What does a typical project look like for the Home Depot? Another store. They have hundreds of stores. But for other companies that take one project every 2 or 3 or 4 years, this gets a lot messier because you don't have much to build on, but you still have to make your best. That's the revenue side. Let's look at the expenses. At the theme parks, I've assumed that the expenses will be 60% of the revenues. These are the actual operating expenses. People at the theme park, all of the stuff that you need to keep the theme park operating. For every dollar they get, 60% goes into expenses. These are direct expenses with running the theme parks. At the resort properties, 75% of the revenues go to maintain those properties, a much higher percentage. Again, I'm basing it on my existing theme parks because that's all I have to go on. Then I'm going to do something that I'll have to come back and clean up. Remember, Disney has a lot of businesses. They also have expenses that are all over the place. I'm going to allocate this item called G&A expenses, some of this to the theme. I'm going to ask you a generic question. Every company you look at, you'll see this item called G&A, sometimes summed up with selling, but let's say G&A expenses. What is G&A expenses? What goes into it? In fact, most of you work at large companies, right? And have you ever wondered what people do? There's an entire floor of people who claim to do things and I don't know what they do. They're like floors and floors of people. In other words, there are a lot of people who create no revenues, including the top management, right? Bob Iger does not create any revenues for Disney directly. These are expenses without revenues, and that drives accountants crazy. So what do? They gather together all these expenses, and they go looking for a place to attach them to. Oh, you have revenues? How about some expenses? You say, no, I don't want. That's when you discover the family feeling. The part of Disney you take. So allocating these expenses is the accountant's way of saying, I don't know what to do with these strategy group, We pay them a lot of money. They take up an entire floor. It costs us $150 million to pay these guys to come up with strategic vision. That's got to go somewhere. So I'm going to take my, and it's set as a percentage of something, right? We have to allocate based on something. In this case, it's based on revenue. So because the theme park is going to have revenues, your G&A cost that's going to be allocated is going to be 15% of those revenues. But then I'm going to back up and say, only if you look at these revenues, 2/3 of these revenues, of these G&A costs are fixed. They have nothing to do with the project. I'm allocating them. 1/3, I have to hire an extra accountant, an extra strategy person, are variable. They're related to the project. File that away. I've allocated the entire expense, but I've also told you 2/3 of those expenses have nothing to do with the project. Remember the word incremental? This is going to come back to play when we look at that expense. Now, if you, those original investments I showed you, the $5 billion that they've invested, the $500 million they've already spent, the $4.5 billion to go, those are capital expenses. What does that mean? I'm going to depreciate. 50 years ago in the US, companies could pick their own depreciation method, and the IRS discovered very quickly that they lost control of the process because they kept coming up with these new depreciation methods that allowed them to depreciate more upfront. So now, for most US companies, your depreciation comes out as scheduled. The IRS will give you, given the kind of investment. You still have some wiggle room, but not a whole lot of wiggle. So this is the amount of the depreciation that's going to come up because of your investments starting in year 1, year 2. And there's a second line item, it says capital maintenance. We're not maintenance, it's maintenance, you keep things going. Capital maintenance is maintenance on a big scale. Again, using a Disney theme park, it's replacing an entire ride. So you take an existing ride, so you shut the ride down, you spend 6 months and tens of millions of dollars to build it. What's different about it? It will now become part of your capital base and it too will get depreciated. It's a percentage of your depreciation. And the reason it's a percentage of your depreciation is think of what depreciation is. Accounting depreciation is whatever it is, but economic depreciation, your existing rides start to wear down, right? And you need to put money back. Otherwise, those rides are going to start breaking down more and more. So there'll be no rides at all. Capital maintenance is what you do to keep the theme park going. It starts low. Why? Because your theme park is still new. But as you age, you're going to start to see that capital maintenance get higher. And it's because you want to keep the theme park going. You see, why do I want to keep the theme park going? This is going to be another question we're going to have to examine. I'm going to stop in year 10, but you have to decide, are you going to keep the theme park going after year 10? Or are you going to just shut the theme park down? And that choice is going to determine what you put back into the theme park to decide, is this a going concern that I want to maintain at ship shape so that I can keep this theme park going? So the first column is the depreciation that you're going to get on your existing investment. The second is the new capital additions, investments you have to make to keep the theme park going. You can always tell when you walk into a business, the businesses that spend nothing on capital maintenance, as opposed to, I mean, the old malls, this used to be a classic example. You could tell which retail stores spent money on capital maintenance and which didn't, because you walk into a store, first day, every store looks new. You go back 5 years later, some of the stores still look new. And some of the stores look like crap. You don't even want to go in there. That's because some companies seem to think investment is upfront. You don't have to invest after that. And you very quickly realize that that's not true if you want to keep a business going. And finally, I'm going to introduce an item which is part of cash flows, but you have to think about it explicitly. Let's go back to the retail store example. You start a retail, you decide to open a store. Before you open the doors to the store and have customers come in, what do you need to put on the shelves? Inventory, right? Without items on the shelves, nobody's going to come in and buy anything. You're saying, so what? That inventory, while it's sitting on your shelves, is tying up cash flow. You're saying, but once I sell it, when I get the cash flows back, you will, but because you want to keep running the store, what do you need to do? When you sell something, you need to replace the inventory. So items like inventory tie up cash flows. When you sell items on credit and you don't collect interest, it ties up cash flows. So investment in working capital is what you put into these working capital items that tie up cash. So I'm going to give you what that item is going to do in this project. They have to maintain their non-cash working capital, inventory, receivables, etc., at about 5% of revenues. That's going to play a role in affecting my cash flows. I'm going to tell you, because of the way we do things in terms of discrete timing, whether it happens at the start or the end of the year, that's going to drive the cash flows. That investment is going to be at the end of each year. Yes,
Is capital maintenance an expense or is that capital?
it's capitalized, right? So in the case of Disney, the way it works is, I'm thinking of the ride that we walk by now. Tower of Terror. There used to be a Tower of Terror in California Adventure. That became Guardians of the Galaxy about 2 years ago. But to make it Guardians of the Galaxy, Disney had to spend about $40 million on it. That $40 million was capitalized, put on the books as an asset and depreciated over time, because you're not allowed to expense it. If you were, you would take it, because it is a physical investment, it's a big investment. So that's the capital maintenance difference between regular maintenance, expense, and capital maintenance, which becomes part of your book value and builds up over time. So let's lay the groundwork. Let's talk about what goes into book value. This is the accountant's measure of what your theme park is worth. This is what's going to show up on your balance sheet. When you have a capital expenditure, it goes on your books. So that $5 billion that you saw initially is going to go on the books as an asset. Now, what's going to happen to it over time? As you depreciate that asset, that book value is going to go down. So if I put in no capital maintenance here, guess what's going to happen to a book value of a project as you track it through time? It's going to get lower and lower and end up at perhaps salvage value, what you can get by selling the assets. But remember, in this case, two things happen. One is I have capital maintenance. So whenever I have capital maintenance, I add that on to my book value because it becomes part of my book value. And working capital is also on your balance sheet as an asset. So add that on as well. So my total book value here includes not just the $5 billion that I invested, it also includes the capital maintenance and it includes the working capital. So I've computed the book value every year. It starts at about 2.5 billion and it builds up over time because of my capital maintenance. If I did not have capital maintenance, my book value would decrease. This is going to become an issue when you compute things like return on capital. You're trusting the accounting capital because you let the book value decrease, your return on invested capital go up, even a terrible project, simply because it's a smaller number than the denominator. So let's start by estimating the earnings. Yeah.
We already made it out.
Yeah, working capital by definition is net of accounts payable, right? So if I meant working capital is current non-cash current assets minus current liabilities. So current liabilities includes accounts payable. It's non-interest bearing debt, right? Supply, credit, accrued. So working capital by definition is after accounts payable and after supply credit. So now remember, as the low person in the totem pole, I'm going to try to estimate the earnings of this project. I've laid the groundwork, so let's go through how to get to the earnings. I start with the revenues, and you saw me build up to the revenues by adding up the two theme park revenues and the resort properties. I subtract out the direct expenses. That's 75% of the theme parks, I'm sorry, 60% of the theme park revenue, 75% of the resort properties. I subtract out the depreciation and amortization. Why? It's an accounting expense. I'm doing accounting earnings. I've got to do the accounting thing. I subtract out depreciation and amortization. I also subtract out allocated G&A, the whole amount. Why? Because I'm thinking like an accountant. So when you do earning statements, remember, you've got to follow the accounting rules, even if you don't like them and you don't agree. We'll reverse a lot of the things the accountants do later because that doesn't make any sense. I come up with operating income. If you take a look at my operating income in year one, it's minus 50 million. In other words, in this project in year one, I'm losing money. Am I surprised? No, because it's an infrastructure investment. It takes a while to build up. So I'm losing money. When I lose money on a project, when I lose money as a company, I don't pay taxes and I carry that loss forward, right? When I lose money on a project and I'm a money-making company, what's the most sensible thing? wait and take the benefits in the future, you take it right away. Take time value. Your tax rate is not changing. So if you have a money losing project in a money making company, you're going to get the tax benefits right away because you're going to offset it against income elsewhere. And that's basically what I've done. See this -18, you're saying, how can your taxes be negative? That's my tax savings elsewhere in the company because of this project. I'm staying incremental. I'm saying I'm a $50 million loss in the project. It saves me 18 million in taxes. I'm using a tax rate of about 36%. My after-tax operating loss is 32 million. If this were a standalone project where I was not allowed to use my losses or profits against other projects, or this was the only project I had, then I could not do this, right? So what would be different if that were the case? In year one, what would I show as taxes? I show 0 as taxes. I keep track of the end. It's a pain in the neck, but you got to keep track of the operating losses. And when you start to make money, you will offset the income in those years. So in this case, I'm not doing it because it's more sensible to take your tax savings right away rather than wait to get those tax savings. Yes. You can answer the question. Does the project affect your income at the margin or does it affect your income in the middle? Is your answer. That's the best way to think about it. Should I use a marginal tax rate and effective tax rate? Is ask yourself, what would my taxable income look like without this project? What will it look like with this project? And by definition, new projects are always going to be at the margin. So there's my after-tax operating income. And no surprises. I start with losses, right, for my first 3 years. And then I start to make money and it starts to build up. By the time I get to year 10, this is a project that's making me a lot of money, $421 million. Remember, you've been kind of sitting there watching me do the numbers. Soon I'm going to ask you to make a decision, right? You've got to decide whether to open this theme park or build this theme park. Now, if I just showed you this table and I said, when you open the theme park, you have sufficient information to make that judgment. Money making, right? 421 million. Why are you being so greedy? $421 million. That's a lot of money. What have I not given? Is 421 million? I'm going to ask you a stupid question. Is $421 million a lot of money? It depends. Depends on what? How much you invested in the theme park. You invest 100 million, you get back 421 million. I can make far more by investing that money in T-bills than taking this project. So I'm going to take these profits you do and scale them. And because I'm thinking like an accountant, what's the most logical thing to scale it to? Of my after-tax operating income, I'm going to scale it to that book value that you saw, because thinking like an accountant, that's what I've invested in this project. So I'm taking the after-tax operating income and taking the book value of capital, and I computed 2 measures of book value of capital. One is the end of the year book value of capital, the other is an average. It doesn't make a huge amount of difference. And I divide the income by the book value of capital and I get a return on capital. So A is with the end of the year, B is, with the average book value of capital, and B is based upon the book value at the start of the year. So basically it's both measures. And by both measures, you see the same pattern. You start with negative returns on capital, but the time you get to year 10, you're going to end up with returns on capital that are higher because the project is building. In fact, if you have a traditional project where you end the project in year 10, your returns on capital become stratospheric towards the end. Why? Because your book value of capital is basically disappearing, right? You're depreciating the project, you're not putting anything back. You're going to end up with 100% return on capital, something to watch out for here. But the average that I get over that 10-year period is about 4%. You ready? Based on my projections for the next 10 years, using historical data, the return on capital you can make on this project is about 4.1 to 4.2%. To decide whether that's sufficient, you need something to compare it to. You need a hurdle rate. So I'm going to give you some choices, and you tell me which of these hurdle rates you would use to decide to take this project. Well, the T-bond rate was 2.75%. Better than that, right? But what's wrong with that comparison? 2.75% is what you can make on a guaranteed, on a risk-free investment. This is definitely not risk-free. So it's not the right comparison. How about the cost of equity for Disney as a company? Let me go back and show you what I did. I took the after-tax operating income, which is the income to both equity investors and lenders, pre-debt earnings, and I divided by total invested capital, the company. I'm measuring the return to all investors in the company, right? What's wrong with comparing to cost of equity? Cost of equity is what equity investors demand. So you're going to cross out B and C, not because they can't be used as hurdle rate, but they can't be used given the way I've computed returns. In fact, what measure of returns would I have had to use for cost of equity to be the right comparison? What should I have done in the analysis? Instead of using after-tax operating income, I should be focusing on what's the income to equity investors? Net income and divided by book equity. It's called return on equity. If I computed a return on equity, I can compare the cost of equity. I didn't do that here. I did return on capital. Later on, when I do the Vale project, I'll do it based on return on equity. There you'll see me using a cost of equity. I'm not using two sets of rules. I'm using the same set of rules. I'm just being consistent. So I can't use A because the investment is not risk-free. I can't use B or C because I'm looking at total capital. So it has to be a cost of capital. So I'll give you two choices. I can use the cost of capital for Disney as a company, and the cost of capital for Disney theme parks. Kind of answer this question, right? When you look at a project, what should you be using as your hurdle rate? The cost of capital for the division of business taking the project, not the company overall. So 6.61% looks like the right hurdle rate. But there's one small catch. That 6.61% reflects Disney's existing theme parks in 2013. And remind me again where they were in 2013? Orlando, Anaheim, Paris, Tokyo, and Hong Kong was just a glimmer in their eyes, primarily in developed markets. Where's this new theme park going to be? It's going to be in Rio. So here's my question. 6.61% is the cost of capital theme park for Disney as a business. Clearly, this is a theme park in a foreign market. It's not in Anaheim, Orlando. The question is, should that affect your discount rate? If I'm doing things in dollars and this theme park were built in Frankfurt, I would say, look, I can use a 6.61%. It's a mature market. You see, what about exchange rate risk? If you're Disney, remember the top 17 investors in your company, they include BlackRock and State Street and Bank. I think they take care of themselves. Because the dollar gets stronger, some of their companies benefit. Exchange rate risk by itself, for most companies, large publicly traded companies, even mid-sized publicly traded companies, should not affect your discount rate because your investors can take care of it. But the risk that is not in the 6.61% is the fact that Brazil is a riskier emerging market. I need to fix it. Intuitively, I need to be using a higher discount rate than 6.61% to reflect the country. And luckily, we've kind of laid the groundwork for it. The way you adjust the discount rate for country risk, what's the input, the three inputs that go to cost of equity, risk-free rate, paid in equity, risk premium. Which is the input that's going to be affected by country risk? My risk-free rate in dollars is going to be the risk-free rate. My beta is going to be the beta for theme park. My equity risk premium should be what reflects what market I'm going into. So what I'm going to do is I'm going to take the calculation I did for my cost of equity for the theme parks, use the dollar risk-free rate, it's still in dollars, use the beta for theme parks, it's still a theme park investment, but replace the risk premium that I was using with the Brazil equity risk. We're laying the groundwork for how multinationals should be thinking about projects. You cannot use one hurdle rate. If you're a multinational company like Coca-Cola for projects around the world, because a project in Russia should be definitely more risky than a project in France and Germany. Your equity risk premium becomes a conduit for that risk. In this case, using the higher equity risk premium gives me a cost of equity of 9.16%, which translates into a cost of capital of 8.46%. So the only thing I had to change was the equity risk premium in my cost of equity. Using a 6.61% cost of capital, we're going to use an 8.46% cost of capital. I want to pause and make sure that everybody everybody's clear about what we're doing. We're adjusting the discount rate for the fact that it's a theme park investment and also for the fact that it's in Brazil. Just in your mind, think about what if Disney were thinking about a new movie business in India and think about how you would compute the cost of equity. And then ask yourself, what would I do if I had to do this in rupees? Get comfortable moving across currencies, across businesses, across countries, because that's something multinationals should be doing whenever they look at projects. So 8.46% my cost of capital. So now I come back to you. Remember the numbers I computed, the accounting return on capital, 4.1 to 4.2%. Now I have a cost of capital, a hurdle rate to compare to 8.46%. Sounds like a easy decision to make, right? Based on those numbers, it looks like you should reject the project. But if you remember, when I did return on capital, the pattern that you saw early on was negative, and as I kept going further, even with the capital maintenance, the return on capital kept going up. I stopped in year 10. Why? Half of all capital budgeting analyses, we use a 10-year, like same thing, valuation, 10-year time horizon. What's so special about 10? Do things fall off the cliff in year 11? I'll give you my reason. It's completely, maybe you might think it's facade. I think it what fits comfortably going landscape and Excel on one page. There's no good reason for it, right? Why 10? Why not 15? 15 is a pain in the neck. I know you can shrink to fit, but nobody can read what you shrunk. 10 is nice and comfortable. You can do 10 years across. No, there's no good reason why I stopped in 10 other than convenience. And in this case, I think I'm being incredibly unfair to this theme park by stopping here. You're saying, why? What if I use 10 years as my life for everything I do? If I have a movie project and I use 10 years, most movie projects kind of run their course. But if you look at a theme park and you look at when it starts to become a cash cow, when it starts to make money. How old is Disneyland? 70 something, 1956, I think is when it got built. Disney World was 74. Disneyland makes far more money for Disney now than it did 10 years ago, 20 years ago, and definitely far more money than it did in the first 10 years. When Euro Disney was first built in the 1990s, I remember reading the horror stories, but this is a terrible investment for Disney. Look at how much money they're losing. And if people had any sense of perspective, they looked at the first 10 years of Disney World and Disneyland, Euro Disney was actually in a better track to make money than either of those. I'm killing this project just as it's starting to bear fruit. And in this particular case, I think that's unfair. There's nothing I can do with accounting returns other than projecting year 11, year 12, year 13. But with cash flows, I'll give you a trick you can use to extend the life beyond year 10 without having to do the detailed projection for year 11, 12, which is the pain in the neck that we want to avoid. So accounting return on capital is still used by a lot of companies. I'm going to give you the statistics of what percentage of companies base their project analyses on which approaches. And I think a third of all companies still pick projects based on return on equity and return on invested capital. Why? Because CFOs take the accountants, this fits their way of thinking, they think about earnings per share. But you can already see the limits, right? Let's check it against our measure, a good measure of return. Is it based on cash flows? No, it's accounting earnings. Is it incremental? No, I counted everything, right? The $500 million sunk cost, the G&A cost. Is it time weighted? I average returns on capital over time. My best returns on capital were in year 8, 9, and 10. This is the exact opposite of a good measure of return, right? It's not cash flows, it's not time weighted, it's not incremental. Just saying, why do we still use it? Because people are familiar with it. They talk about return on equity and return on invested capital. And from an accounting perspective, it fits into the accounting way of. Now we'll come back and talk about how to fix the fact that it's not a good, but I'm going to take a little tangent. What do I need to compute return on invested capital? I need an after-tax operating. I need invested capital, book value. It's basically book value, right? Can I compute the return on invested capital for an entire company? Why not? I have the after-tax operating income for the entire company. I have the book value of equity and the book value of debt and the invested capital for the company. And if I do that, I can answer a question that I think we all need to answer before we get too ambitious about a company. Remember, I talked about a company being a combination of investments, it's already made assets in place and growth assets. Before you get too ambitious about growth assets, it's worth pausing and asking the question, how good are my existing investments? So think about whichever company you pick and say, how good are my existing investments? Is this company a history of taking good investments? So one way I can try to answer it is I can take the after-tax operating income for the entire company and divide it by the invested capital for the entire company. And the invested capital is the only place in finance we use book values. And we're doing it because we want to get a sense of what did Disney actually invest in Disneyland and Disney World. We're trusting book values to capture that. So book value of debt plus book value of equity minus cash is called invested capital. You divide after-tax operating income by invested capital, you get a return on invested capital. For Disney, that number is 12.618. You say, what do I do with that? Remember their cost of capital based on that bottom-up approach we used was 7.81%. To the degree that you trust their return on capital, they're earning more than their cost of capital. I think return on invested capital has become this magical number for people, but remember, to the degree that you trust the return on capital, it's the start of the conversation, not the end. In the case of Disney, when you earn more than your cost of capital, I want you to remember Econ 101. When a company earns more than its cost of capital, what has to be true? It has to have some, if you truly trust that return and it's making more than the cost of capital, there's got to be some barrier to competition, right? If you have perfect competition, every company would earn its cost of capital because competition would come and take away the excess. What's a competitive advantage of barrier to entry that Disney has? This is an easy one that allows it to earn more than its cost of capital. Don't forget the mouse with the ears, right? With just capital expenditures, they'd be in trouble. Because Universal can spend money, Amazon can spend even more money. You can't reinvent the mouse with the ears, right? Those characters. I mean, think of the premium we've charged for a Disney cruise. You don't pay it because you're going on a cruise, it's because you want your kids to experience. This is the magic that Disney has, and it's not impenetrable. I mean, that magic can fade. They actually flirted with losing that when they got distracted. But the competitive, so what I'd like you to think about when you do this for your company, if you get a return on capital higher than the cost of capital, remember your company is already exceptional. I'm going to see why in the next page. I want you to stop and ask, what makes my company exceptional? What does it do that gives it that excess return? That's what your project is. It's not computing the numbers. In fact, I have a spreadsheet. I won't give it to you, but if you enter the raw numbers for your spreadsheet, it does all the numbers for the entire project for you. I want you to work through the numbers because there is some value, but really this is not about working through the numbers. It's about reading the numbers and telling me a story about your company. And I do the same thing for my other 5 companies. And I think in this case, every one of the companies except for Bookscape earns a return on capital higher than the cost of capital. With each one, it's a different competitive advantage. With Vale, it's the fact that they own these iron ore reserves, and you're not going to be able to come in as a new competitor and take those away. For Baidu, it's the fact that they're the search engine for most Chinese, and Google can't come in and compete because the government acts as your protector. And for Tata Motors, if you break them down into their Indian business, where they're a mass market company, and the Jaguar Land Rover, on their Indian business, the return on capital is very close to cost of capital. What's helping them is Jaguar Land Rover earns well above its cost of capital. Their brand name, the fact that people pay this premium for a Land Rover, even though you might live in the suburbs and you don't need this car that can go over like 15 mountains. But that's basically the brand name. And Bookscape is a little unfair because they actually earn more than their cost of capital if they were a publicly traded company. But because the owner is not diversified, we're using a total beta, it's pushing up the cost of capital. And it does mean that the owners are constantly going to feel the pressure. Should we keep doing this or sell or get out of the lease and put our money into a mutual fund, we would actually earn a fair rate of return. You can see already why private businesses, especially as generations shift, are going to find their way to become parts of public businesses or just stop. Now, of course, as I said, this is the only place in finance where we use book values. And with accounting return numbers, that should terrify you. Why should it terrify you? Everything accountants do can affect your return on invested capital. We don't do returns on invested capital for banks, but we do returns in equity, right? And remember, the accounting choice of allowing that Silicon Valley Bank to keep its bonds at face value rather than at the 20% discount will affect your book value and your return. So when you look at accounting returns, there are all these issues that can affect accounting returns. And the reason I bring this up is that I said this has become this magic bullet that consultants and bankers talk about. But I want you to walk in with open eyes. Your accounting earnings can be contaminated by what happens in terms of unusual spurts or drops in earnings, one-time charges, by the life cycle of the company. Young companies will have terrible returns on capital, even if they are good companies, because you're capturing them early in the infrastructure. Remember Disney's theme park in years 1 and 2. And in the denominator, everything accountants do will affect your invested capital. You take a big restructuring charge. The minute after you take the restructuring charge, your return equity and return invested capital will look much better. Why? Because you lowered your denominator. And by lowering, so I'm not trying to talk you out of it. In fact, I want you to compute the accounting return on capital for your company, but I want you to also recognize that that return on capital is just one metric, a number that can get skewed by accounting choices and what happened during the most recent. So one of the things I do at the start of every year, in spite of all the things I've said about return on invested capital, is I compute the return on invested capital for every publicly traded company in the world. The 45,000. Not a big deal, right? It's like, and I'll confess, I make a few adjustments. I do capitalized leases for all companies, which now IFRS and GAAPs makes US and European companies do, but I do this for all companies. I also capitalize R&D, so I try to do my own cleaning. I get a return on invested capital for each company. I also compute a cost of capital for each company. Now I do everything in dollars to keep the comparisons on one currency, but I use the T-bond rate as my risk-free rate. I use the beta of the business, so it's a bottom-up beta for every company. And I use an equity risk premium reflecting the country in which that company is incorporated, because unfortunately with S&P Capital IQ, I don't get a breakdown that I can use easily. So I come up with the cost of capital each. So there are limits because you're doing this for $45,000 companies. You're going to make some assumptions that are simplistic. Then I compare each company's return on capital to its cost of capital. You see why? I said if you have competitive advantages, you should earn more than your cost of capital. I'm going to do a very simple test. What percent of companies globally earn more than their cost of capital, creating value in the value sense? And what percent of companies earn less than the cost of capital? And the statistic has been horrific for a decade, and it got even worse in 2020. Globally, if you look across all 42,409 companies, 69.4% of all companies earn a return on capital less than their cost of capital. 7 out of 10 companies. Some of them will have good excuses, right? I'm a young company, I'm going to grow out of it. But a big chunk of the 70%, maybe 40%, have been earning less than their cost of capital every year for the last 10 years. There's no escape hatch. You're in a bad business. Airlines have been earning less than the cost of capital for 40 years, but you don't exactly see them. The reason is simple. When I say they earn less than the cost of capital, I'm not saying they're losing money. They're making money. They're just not making enough money given the capital investment. Why don't they just shut down? Why doesn't that happen? Because you're not earning your cost of capital, might as well live. What's the problem with shutting down the business? Are you going to get your capital back? No, because you try to liquidate an airline, you're going to get the price that reflects whatever the people are. So it's not like you're in a trap and you can't get out. It's not as simple. Some of these companies run on hope, things are going to change. But some of these companies are trapped in bad business, they can't get out. So that's why I said when you do this for your company and you come up with a return on capital that exceeds the cost of capital, you're already way ahead of the game. So compute your after-tax return on capital. If you want to do it for 2022, 2021, if you want to see, get some smooth that number, compare it to the cost of capital. If it's higher than the cost of capital, even by a little bit, you're already a winner. You're one of the 30%. If it's much higher, like it was for Disney, then stop and ask the question, what are the competitive advantages that my company has? And then follow up asking, what are the threats to those competitive advantages. If it's a brand name company, you're worrying about will my brand name fade? Is my core market aging? Kraft Heinz, classic example, great brand name, but the brand names fade. Now, so that's really what you're asking when you do this analysis. It's a useful piece. It's just a piece of the puzzle, but it's a useful piece of the puzzle for you to understand your brand. Any questions in accounting, return on capital and cost of capital? You could also do return on equity and cost of equity. You saw the previous table, I did both. Statistics don't change much, but stay consistent because that's the only comparison. So we've got accounting earnings on this project, but as I said, a good measure of returns is based on not just cash flows, but incremental cash flows. Let's do the cash flow part first because it's the easier part of this equation. To get from earnings to cash flows, remember, there are only three adjustments I need to make. First, I need to add back the depreciation and amortization. You see why? Because I subtracted it out to get to operating income. But I already told you it's not a cash expense, it's an accounting expense. I add it back. I know some of you are saying, why did I if you're going to add it back, why not just do EBITDA? I've seen people actually do this. They say, I'm going to subtract it and add it back. Let's ignore. You're going to see why I cannot do that. I have to subtract out the DAR, come up with the after tax, and then add back the DAR because I'm going to miss something very critical if I don't. So I'm going to add back depreciation and amortization. I'm going to subtract out capital expenditures. Why? It's a cash flow. You can tell me till you're blue in the face, it's not an expense, but I have to spend the money. And I'm also going to subtract out the change in working capital. Why the change? Because if I have $500 million in inventory at the start of the year and $500 million at the end of the year, I'm not adding any investment. There's no additional cash flow. It's a change in the working capital. So there's my depreciation amortization being added back, the capital expenditures. And now you start to see numbers that are closer to what I'm actually spending. So I've got my cash flows everywhere. I want to break apart the three adjustments I made. Let me take the depreciation amortization. Say, why are you wasting your time? You subtract out and add it back. Here's why I had to do it. When I subtracted our depreciation amortization to get to EBIT, remember I applied the taxes on the EBIT? The depreciation was giving me a tax benefit. So even though it looks like it's neutralized, there's a residue left over, and the residue is going to be the tax benefit I get from depreciation. So to make it more explicit, there's my depreciation each year on this project. There's the tax benefit from the depreciation, just the tax rate times the depreciation. So already you can see two implications come up. If you're a company with a higher tax rate, you get a much bigger benefit from depreciation than if you're a company with a lower tax rate. So let's play a game. Let's suppose you guys are very wealthy individuals, and let's say your tax rate is 70%. That was the tax rate in 1981. Let's say you're a corporation, and your tax rate is 35%. Who gets a bigger benefit from depreciation? You do, right? But you don't need a factory, you don't need planes. So here's what you do. You're an airline. You get only a 35% tax benefit, and they get a 70% tax benefit. You let them buy the aircraft and lease it to you. That way they get the 70% tax benefit. The lease business was built on having divergent tax rates. As tax rates have converged for individuals and corporations, it's hurt the lease business, not made it go away. But in the 1960s or 70s, this was the basis for why wealthier people would often buy assets and lease it back, is because you then got the 70% tax benefit from your depreciation. And if you're a non-taxed entity, why are you wasting your time doing depreciation in the first place? It doesn't have, then you can ignore depreciation because there you have no tax. So when you look at items like depreciation, it looks like it's neutralized when you subtract and add it back, but remember there's a tax. And if you have a non-cash charge that does not have a tax effect, then just ignore it. Can you give me an example of a non-cash charge that might not have a tax effect or will not have a tax effect? Sorry, what?
Amortization?
Amortization of what? Some amortization is tax deductible. Think amortization of things like goodwill, completely useless. This is why when you see goodwill, you've heard of it. In the old days, you actually used to write off goodwill over 40 years. Now, of course, you impair goodwill. So an accounting team will land and say, we're impairing goodwill by $7 billion. Sounds like a terrible thing to happen to a company, right? It's a $7 million loss you're going to report. You know what the market price reaction to goodwill impairment is? Zero. You know why? Because by the time the accounting team lands in, everybody knows you paid too much on the acquisition. Your market price is already adjusted for it. So when SoftBank announced that their WeWork investment was a terrible investment, everybody on it said, we know. We knew 3 months ago. You know, so you wonder, why do we spend money paying accountants to impair goodwill? Because it gives accountants jobs. So that's a good thing that comes out of it. There's nothing that I have never in any of my valuations ever learned anything from an accountant impairing goodwill. If it were tax deductible, then I would care, but it's not. Second, let's talk about depreciation in a little more depth. Remember I said in the old days, you can pick your depreciation method. And broadly speaking, depreciation methods can be classified into straight line or accelerated depreciation. In both cases, you get the same amount of depreciation, but in one case, you get more depreciation up front and less later on. In this other case, you get the same amount of depreciation. So I want you to think about a choice. So let's say you're a company, you're deciding whether to take straight line or accelerated depreciation. And I want you to think in terms of earnings in the near term of these choices. So straight line versus accelerated, which will give you higher earnings in the near term? Straight line, right? So you see, this is good for higher earnings, but which will give you higher cash flows? Right, because you get the tax benefits earnings. Would it be nice if you could have your cake and eat it too? And a lot of companies do. In the US, you're actually allowed to use straight line depreciation in your reporting books and accelerated depreciation for your tax books. Which is the reason tax income and reported income almost never match up. If you go to the Federal Reserve site that tracks tax income reported, it's significantly lower than, and one of the reasons is straight line versus. So you can already see the impulse to use straight line depreciation comes from wanting to report higher earnings. And the impulse to accelerate it. So you got to decide which matters to you more. If you had to pick and both your books had to have the same, my advice is most of the time go with accelerated depreciation. You say, why most of the time? If you're a non-tax paying company, you're a money losing company, then it might actually pay for you to wait because, taking the depreciation right now is not helping. But to the extent that you get a tax benefit, you want to get the most you can. Talk about capital expenditures. Again, the accounting rationale is if you have a big expense, you get benefits over many years, it's a CapEx. It's fine. I understand that. But I want you to think both again about that classification. New CapEx is what you do to get a project going. Maintenance CapEx is CapEx you do to extend the life of the project, to make it produce revenues for all. So if I ask you, should you do capital maintenance? It'll depend on whether you want to run this project into the ground over the next 5 or 10 years, or whether you want to keep the project going. You're going to give me different answers depending on that choice. But both matter, both the cash flow effects and the need for capital maintenance will increase the longer you want your project to live. There's no freebies in this world. You get more cash flows if you run the project into the ground in the near term. But then you got to accept the fact that you can't get to year 10 and say, we'll keep going, 3% growth forever. You can't have your cake and eat it too. That's what your end game is. So again, as with depreciation, I'm going to ask you a question. Let's suppose you are, this is a very old example, because nobody does this anymore, but I remember a time we used to get CDs in the mail. People in the AOL used to send CDs and they try the CD out, And they did it because they would, but let's make this more updated. You're a user-based company and you offer special deals. DoorDash will offer you a deal, right? You're going to become a customer and you can have 30% off for the next month and a half. Does it cost them? Yes. Why are they doing it? Because they want to add to the user. It's a capital expenditure, right? And maybe you can argue that you should treat it as a CapEx because you get more users over time. But let's think in terms of earnings and cash flows. If you have a choice, and let's say you do have a choice, that you can either CapEx something or expense it right away. Which one is going to make your earnings look better? To expense it right away or to CapEx it and write it off of it? To make your earnings better, you want to capitalize everything. That's why Groupon want to capitalize everything, make their earnings look much better. But from a cash flow perspective, if you're paying taxes, you want to expense things right away. And again, you can see the impulses pushing you in different directions. If you're a money-making company, you want everything expensed if you can, as quickly as you can, because you get the tax benefits right away. Nobody benefits from writing things off over 10 years if you're a tax-paying company. If you're not tax-paying, then of course, the choice becomes different. And lastly, let's talk about working capital. As I said, the working capital effect comes from the fact that things like inventory and receivables start up cash. You're saying, what about cash balances? Remember, I said non-cash working capital because our objective is to come up with cash flows. It's kind of silly to lower cash flows because you want to keep a cash balance. So it's non-cash working capital. And it ties up cash because while it's sitting on your shelf, the inventory cannot be covered. But when I look at capital budgeting exercise, especially done by small businesses, this is often the most ignored item in capital budget. Because a person sitting down to do a new project thinks about the capital expenditures, the building, the land. They don't think about inventory as part of their investment. This is the way it shows up. You have, if you go down Bleecker Street and even in the 2 years a year, you notice enough turnover there. Every 6 months stores turnover. One of the reasons is these stores can be making money on the books, but they're cash poor because they have so much cash flow tied up in inventory. That's why if you ignore working capital, you're going to overstate the net present value of these projects because that cash has to be planned. You got to be, in fact, if you plan for it right, you might actually take on financing to cover your working capital needs but if you fail to do it, net present value is going to look much better. And if you are a company, you can be more efficient about the way you manage your inventory, it's going to affect your cash flow. Now, I'll give you a final example. Until about 20 years ago, you looked at accounting textbooks. The advice you were given is your current ratio should be 2. You know what that means, right? Your current assets should be twice your current liabilities. That's what a healthy company is. And they would pass this advice around. And with the advice that retail firms used to follow. If you think about keeping current assets twice current liabilities, that's a huge drain on your cash flows. And then Walmart came along and they asked, why? They made up this 2, and nobody seemed to know the answer. And one of the things Walmart did that revolutionized the business was they changed the way they managed it. And now, of course, everybody does it. They wanted to come up with a current asset that was roughly equal to their current liability. You know how much it's generating cash flows every year? About $2 billion in cash flows just by doing it. So for businesses that are working capital intensive, this can be a big part. Now, and if you think about places where big data can help you, I would consider that. This can be one of those places. You can use the data you're collecting on customers and what they're buying, reduce your working capital needs. It can pay off as high cash flows. So I'll see you on Wednesday, and if you haven't started working on the case, please do start.
Yeah.
From that, 20% people from quick, from Sao Paulo, from Venezuela, from Peru, it's easier often to get to Orlando than it is to get within that. So we're going to talk about cannibalization. Some of the people that come to the school have gone anywhere. You say the incremental argument, I shouldn't be counting them. I would have got them as customers anyway. They're different teams. So I think that's something that will have to wrestle with cannibalization, create a new product. Absolutely create a new iPad. The people who have bought the old iPad will not buy the who's now shift to the new iPad. So are you really making the money you think you're making?
Every time Starbucks opens a store, they have to ask the question, how many people come into the store, they come into the Starbucks that 3 blocks away.